Two headlines. Same day. Same country. Same economy. Headline 1. S&P 500 hits another all-time record high. Headline 2. More than half of Americans are living paycheck to paycheck. Both of these are true. Not one of them is exaggerated. Not one of them is fake news. And if that doesn't make you stop and ask, wait, how is that even possible? Then you haven't fully understood what is actually happening to your money right now. Because here's what nobody is connecting for you. This isn't a glitch. This isn't temporary. This is by design. And by the end of this video, you're going to understand exactly who designed it, exactly who it benefits, and the 3 specific moves that put you on the winning side of this divide. Stay with me. Hey everyone, welcome back to Gigi Invests, the channel where we cut through the noise and tell you exactly what is happening with money in plain English. If you are brand new here, hit subscribe right now, because this is exactly what we do every single week. And if you have been here before, you already know. Let's get into it. Bar chart section 1, the myth everyone believes. Alright, so before we go anywhere, we need to kill one idea that is causing a lot of confusion. And that idea is this: the stock market equals the economy. You hear this all the time. Market is up, economy must be doing well. Market is down, recession must be coming. Except that is completely wrong. The stock market has never measured the economy. What the stock market actually measures, specifically the S&P 500, is the expected future profits of the top 500 largest corporations in America. That's it. It does not measure the price of your groceries, your rent, your wages, whether you can afford to fill up your gas tank. None of that. And right now, the gap between what the stock market is measuring and what you are actually experiencing is wider than it has ever been in modern financial history. Let me show you exactly how wide. The University of Michigan Consumer Sentiment Index, which has been tracking how Americans feel about the economy for 75 years, just hit a record low. Lower than COVID. Lower than the 2008 financial crisis. Lower than any point in the last 3/4 of a century. And at the exact same time, the S&P 500 keeps hitting record highs. These two things are not contradicting each other. They are telling you the same story from 2 different perspectives. One perspective is Wall Street. The other perspective is yours. And right now, those 2 perspectives have never been further apart. Section 2, the real economy versus the market economy. So here is something that should genuinely make you stop and think. In Q1 of 2026, analysts broke down exactly what was driving US GDP growth. And what they found is that AI-related spending alone was responsible for roughly 3/4 of all US economic growth. 3/4. Strip out AI spending, and GDP growth drops to approximately 0.5%. Technically still growing, but essentially flat. Now, here is why that matters for you personally. 5 companies: Amazon, Microsoft, Alphabet, Meta, and Oracle are expected to spend somewhere between $800 billion to $1 trillion on AI infrastructure this year alone. Data centers, chips, power infrastructure, buildings full of servers. To put that in perspective, the entire GDP of Sweden is around $760 billion. So 5 American companies are spending more than an entire country produces in a single year, mostly on buildings filled with computer chips. And when a data center gets built, GDP counts it as economic growth, the same way it would count your pay raise. Which means, when you hear the economy is growing, and you look at your own bank account, and think, that doesn't feel right, you are not wrong. You are measuring the economy through your paycheck. The GDP number is measuring data center construction. These are 2 completely different realities, being reported as the same number. And that single fact explains most of the confusion you are feeling right now. But here is where it gets really personal. Because the numbers I am about to show you about who is actually capturing all of these gains are going to change the way you see every single financial headline from this point forward. Section 3: Who is actually winning? So now we need to talk about the part of this story that nobody puts in the headline. Because if stock market gains were spread evenly across the population, record highs would be great news for everyone. But they are not spread evenly. Not even close. Here are the actual numbers. Straight from the most recent Federal Reserve data. The top 1% of Americans own 50% of all stocks. $27.6 trillion. The top 10% own more than 87%. Which means the bottom 90%, 9 out of every 10 Americans, split the remaining 13% between them. And the most striking number of all, the bottom 50% of Americans own just 1% of the entire stock market. Now, technically, 58% of Americans own some stock. That is true. But the median American family that owns stock holds about $52,000 worth, mostly locked inside a retirement account. If the market goes up 10%, the median family gains about $5,200. Meanwhile, that same 10% return for the top 1% of Americans represents $2.7 trillion in total new wealth. $5,200 versus $2.7 trillion. Same percentage. Same market. Completely different reality. And here is something else that most people never consider. The median American family's wealth is not primarily held in stocks. It is held in their home. And a home is not liquid. You cannot sell your house tomorrow and have cash in your hand by Friday. You need a realtor, inspections, negotiations, escrow. At the fastest, you are looking at 30 to 60 days just to access that wealth. Meanwhile, the top 1% can liquidate stock positions and have cash available within days. That difference in liquidity is one of the most underrated drivers of the wealth gap in this country. Section 4: The K-shaped economy and why it just got worse. Now, economists have had a name for what we are describing for a few years now. They call it the K-shaped economy. Here is what that means. Imagine the letter K. The top line goes up and to the right. The bottom line goes down and to the right. The top line represents high-income Americans whose wealth, spending power, and net worth keeps climbing. The bottom line represents everyone else whose real purchasing power keeps declining. And the data on this is almost uncomfortable to look at. The top 20% of American households, those earning around $175,000 or more per year, now account for nearly 60% of all consumer spending. Their spending grew 6.5% year over year. That is comfortably beating inflation. The bottom 80%, their spending grew just 2.6%, which means after adjusting for inflation, the bottom 80% of Americans are spending flat to negative in real terms. Let that land for a moment. 8 out of 10 Americans are losing ground in terms of real purchasing power every single year. And it gets worse. Economists are now saying the K-shape is no longer accurate enough. They are calling it the E-shaped economy. 3 prongs. The top prong continues to pull away. Wealth growing. Spending growing. Portfolio balance is up. The bottom prong continues to fall behind. Delinquencies rising. Savings depleted. Credit card debt at record highs. And the middle prong. This is the new and alarming one. The middle class, which has historically been the stabilizer of the entire American economy, is now treading water. They are still paying their bills. They are still spending on necessities. But they have no cushion left. And that matters enormously. Because historically, even when the top pulled away and the bottom struggled, the steady spending of the middle class is what prevented downturns from spiraling out of control. But now, the middle class is one bad quarter away from cutting spending dramatically. And if that happens, the only thing holding up the entire consumer economy is the top 20%. And when I show you the 3 specific risks building underneath all of this right now, risks that most financial channels are completely glossing over, you are going to understand why the next 12 months could be the most important financial decision-making period of your adult life. Section 5, the 3 biggest risks building right now. All right. So now that we understand the structure, let us talk about what could actually break it. Because right now, there are 3 specific risks that are building underneath this market that are not getting nearly enough attention. Risk 1, the entire economy is running on one trade. Think about what we just covered. GDP growth being driven primarily by AI spending. Stock market gains being driven primarily by the top 10 stocks. Consumer spending growth being driven primarily by the top 20% of earners. And those top earners are spending because their brokerage accounts went up. Because AI stocks went up. Because AI companies are spending aggressively. Which is what is driving GDP. Do you see the circle? One trade. One theme. One domino. If AI spending slows, or if AI revenue does not justify the level of spending happening right now, every single part of that circle gets hit at the same time. Risk 2, the AI spending math has not been proven yet. Here is a number that should give every investor pause. Research from Allianz found that the gap between AI capital spending and actual AI revenue is currently around 46%. That means companies are spending dramatically more on AI infrastructure than they are currently earning from it. Now, to put that in historical context, during the dot-com bubble, the same gap peaked at around 32%. We are currently at 46%. That does not mean AI is a bubble that is about to pop. AI is real. The technology is genuinely transformative. But it does mean that at some point, these companies need to show that the revenue is actually coming. And if it takes longer than expected, markets that are priced for perfection do not handle disappointment well. Risk 3, the Federal Reserve is not done yet. As of right now, markets are pricing in roughly a 75% probability of at least one more interest rate increase before the end of this year. Higher rates mean borrowing costs go up for everyone. Credit cards get more expensive. Auto loans get more expensive. Mortgages get more expensive. And for the bottom 80% of Americans, who are already carrying record levels of household debt and auto loan delinquencies, one more rate hike could be the thing that tips spending from flat to genuinely negative. None of this means a crash is guaranteed. But what it does mean is that the structure underneath this market is more fragile than the headlines suggest. And the people who understand that will be the ones who are prepared when the structure shifts. If this video is giving you a clearer picture of what is actually happening, please hit the like button right now. It costs you nothing and it helps this channel reach more people who genuinely need to hear this. Section 6, what you can actually do about it. Alright. So here is the part that actually matters. Because understanding a problem without a path forward is just anxiety. And that is not what this channel is about. So, based on everything we have covered, here are 3 specific moves that put you on the right side of this divide. Move 1, get into ownership as fast as possible. Here is the single most important insight from everything we discussed today. The entire wealth gap. The K-shape. The E-shape. The $2.7 trillion versus $5,200. All of it comes down to one thing. Ownership. The people pulling away are not just earning more. They own assets that compound while they sleep. And the most accessible form of ownership, available to almost everyone right now, is a broad market index fund. A Roth IRA takes about 10 minutes to open. Index funds cost essentially nothing to hold on a yearly basis. There is no minimum to start. This is not behind a locked door. It is not reserved for the wealthy. The only thing separating you from participating in ownership is the decision to start. Move 2, own the index, not individual names. Here is something important about the current market concentration. The top 10 stocks currently make up close to 40% of the S&P 500. That is the highest concentration ever recorded. Higher than the peak of the dot-com bubble, when the top 10 made up about 26%. Now, some people hear that and think, I should avoid index funds because they are too concentrated. But that is actually the argument for index funds, not against them. Because here is the thing. The top 10 companies in 2010 looked completely different from the top 10 today. If you had tried to pick the winners in 2010, you probably would have gotten it wrong. But if you had just bought the index, you would have owned whoever won automatically, without having to guess. That is the power of the index. You do not need to predict the future. You just need to own it. Move 3, build your buffer before anything else. The national savings rate is currently sitting at under 3%. That means the average American is saving roughly 3 cents out of every dollar they earn. And when something goes wrong, job loss, medical bill, car repair, there is nothing there. No cushion. No runway. No options. And that is exactly how people end up making the worst financial decisions at the worst possible moments. Selling investments at the bottom. Taking on high interest debt. Making panic decisions under pressure. Before you invest a single dollar, build an emergency fund that covers 3 to 6 months of your expenses. Not because cash is a great investment, but because cash buys you time. And time, in every financial situation, is the most valuable asset you can own. Here is the most important thing I want you to take away from this video. And it is something that most financial content will never say out loud. The headline, "Stocks at record highs," is going to keep appearing about 20 to 22 times per year. On average, the market hits a new all-time high. That machine does not stop. The only question, the only one that actually matters, is whether that machine is working for you or running without you. And here is the truth that most financial content dances around. The gap between Main Street and Wall Street is not closing. It is widening every year. And the single most powerful thing you can do is stop watching it from the outside and start participating from the inside. Not with leverage. Not with speculation. Not with all-in bets on individual stocks. Just consistent, boring ownership. That is what closes the gap. Not for everyone at once. Not overnight. But for you. One decision at a time. Starting right now. That is what this channel exists for. Not to make you feel hopeless about a system that feels rigged, but to make sure you understand the system well enough to make it work for you. So if this video shifted something in how you think about your money, please hit the like button right now. It genuinely helps this reach someone who needs to hear it. Subscribe if you have not already, because next week we are going even deeper into exactly which assets have historically protected wealth during K-shaped economic environments, and the ones that feel safe right now, that history says are absolutely not. You will not want to miss that one. And drop a comment below. I read every single one. Do you feel like the market is working for you? Or running without you? Tell me where you are at. I will see you in the next one. Money with Wings.